Hi everyone, so today we're going to be looking at summarizing prepayments and accruals and understanding the basic concepts we've learned before. I thought it'd just be good to put a presentation together just to summarize everything properly. So as we said, we began with the multiple matching concept for prepayments and accruals. That basically means that we record expenses in the period they relate to. And it's the reason why we have prepayments and accruals in the first place, because we need to make adjustments to ensure that we're recording all the expense that's related to a given period and removing any expense that isn't. So you can't, sometimes this works, but you can't just record the sum of the invoices received during a given year. We have to make adjustments to remove unwanted expense, to add any expense that relates to this year, and that we do that for an accrual adjustment. Or we take away any expense that doesn't relate to this year, and we use a prepayment adjustment. Okay, let's explain that a bit more. Let's just summarize. So I've put together a summary of accruals and prepayments, and the thing I like about them is that they're logical and they're complete exact opposite. So here I'm going to put a smiley face next to prepayments and a sad face next to accruals. So accruals are a liability. You're going to have to pay money for the additional expense, whereas prepayments are an asset. You want to accruals normally result in when you have an invoice after the year end, but it relates to pre-year end, whereas prepayments is when you have the invoice before the year end, but it relates to post-year end. Okay, so there's some expense needs to be removed. Accrual adjustment increases expenses and reduces profit, but prepayments reduce expenses and increase profit. Now for both of them we need to draw a timeline, so I'm just going to draw my timeline here. So I'm just going to draw my timeline. This is the year end, and this is my year end. So both of them always draw a timeline out because you need to visualize stuff. Now for accruals, we're interested in the yellow bit. I'm going to call it A1. For prepayments, we're interested in this bit, P1. Now for accruals, all we're just doing is recording an additional expense. So we're calculating the yellow bit here, and we're doing debit expense, credit accruals. Prepayments are a bit different. The reason why is you're getting the invoice before the year end. To record the full invoice amount, debit expense, credit trade payables, that ensures that we know that we owe the trade payable the invoice, and then you make the adjustment. So if I think about it, if I have this, if I have 12k is my full amount. This bit, if this bit is 5k, our expected expense here is 7k. Right? So if I'm applying this principle here, I'm doing debit expense 12k, and I'm doing credit trade payable 12k. Now we need, for debit prepayments, we have to do 5k because that relates to after the year end, and credit expense 5k. So basically what I want to show you is that if you do 12k, if you think of debit and credit as positive and negative, we're doing 12k minus 5k, and what's that giving us? 7k. So it all works out in the end, is what I'm trying to say. Now for accruals and prepayments, step one is the same, so we have to reverse it out, and we do it by doing the opposite of step 2 in accruals case and step 3 in prepayments case. Now for prepayments, what's actually happening is that we're now recognizing, for the same example, recognizing an expense of 5k, and prepayments is going to be 5k. We're releasing the prepayment of 5k. So that makes sense because our expense here is 5k. So we need to recognise an expense this next year of 5k. The accruals is a bit different because when you get the invoice, we record the full invoice amount. So we do debit expense and credit trade payables. Okay. We explained the logic of this in the previous lecture. Right, so I think have this sheet with you when you try to understand accruals and prepayments. It summarizes almost everything you need to know. So I just wanted to show you two formulae that I found helpful in my audit career or accounting career. So total expense. Now remember, when we're beginning a new year, we reverse out the accrual and the prepayment. So when you reverse out an accrual, you're reducing the expense. When you're reversing out a prepayment, you're actually increasing the expense. It's almost as if the prepayment is becoming an expense. When you're putting through this year's accrual, you're increasing expense. And when you're putting through a prepayment, you're reducing the expense, okay? So basically that's it, is that you add up all the invoices received during the year, and then we ensure that and then we just make the adjustments of prepayments and accruals. Okay, so this shows you that accruals are basically, and prepayments are just year-end adjustments to fine-tune our calculation of the expense. Okay, thanks everybody. Cheers, bye.